My name is Bruce Norris, president of the Norris Group. I want to thank you for joining us today. Aaron Norris is directing the show. Craig Hill is also with us, and been a property buyer for about 32 years now, and honestly never seen a better time to do what we do. I know it's hard to find deals. I want to tell you I'm very grateful for our client base. I'm so happy that you guys have the skill that you do to find deals. We've tried to respond this year by lowering our costs, and that's basically what we're going to talk about today, is the things that we've changed on the programs to make them more affordable for you to use us and for us to be able to be competitive with other people that have ventured into our space. Just like in the buying side, we have hedge funds deciding to be buyers. We have people that are stepping into the hard money loan business. So we've responded to that, and you have responded back and said, okay, we're going to use you a lot more. So we're busier than we've ever been, and so we really appreciate that. Craig is with us online. Craig Hill and I have, I guess I borrowed money from him probably 3 or 4 years before he came to work with the Norris Group. Craig, you're here online too?
Yes, I'm here.
Okay. I just want to say that because of Craig's ability to know who to loan to and the ability for him to get people to trust him and the Norris Group with money, it's allowed our hard money loan business to grow. With Aaron's skill and how to market it, with the new way of doing things with the internet, our clientele has grown to where we're now approaching $50 million of hard money that's constantly churning because of the trust that we've been able to build over the years. We were able to get people to go to 8 years for financing, which has been real important for people to be able to buy and hold properties. We just did a boot camp yesterday, and during the boot camp somebody bought a property, and he's going to be able to do a hard money loan that's going to have cash flow, have good leverage, and he's going to be able to hold that property. So that's the whole purpose of why we're in business. So Craig, you and I will be talking about some of the changes. Again, the changes seem to be necessary because we have new competitors in the space, and we have smaller margins than normal. And
right.
So we started looking at a new program and decided we would aggressively do that in January, and that's what we've done. So let's talk about the first program, and the one that we've had the longest, and that's the Rehab Program. The original program that I've borrowed several $1 million of myself was at 3.5 points, and let's talk about the changes that have been made, Craig.
Yeah, basically what we did there is we dropped the points down to 2.5 on the program. We do have a minimum, just to bring that up. Loans under 100,000, which are becoming fewer and far between. Those are a minimum of $2,500 plus the fees. So just as an example of that, a $100,000 loan would be $2,500 at 2.5 points, or a loan of $90,000 would be, $2,500 plus the fees. So that would be like a minimum. We've also lowered the rates on our higher loans. As you can see, loans between 400 and 500 basically is a flat 10,000 plus the fees. So basically that's derived from 2.5 points of 400,000 is 10,000. So that's where we came up with that. And then anything over 500,000 we've reduced all the way down to 2 points. And just a little bit about that range. Most of the rehab loans that we do, I would say our target area, we're probably most comfortable between 100 and 800,000. Certainly we do some smaller ones. We've done a few larger ones, but that's probably our wheelhouse right now. Not that that couldn't change in the future, but those are probably the most common areas of loan amounts for us right now.
Okay, and we still have a 1-year term, and there's no prepay for somebody that pays us off in advance.
Exactly, and then there's no minimum interest. I don't know if that even still exists with other companies, but I know every once in a while somebody will ask me that, like, is there any minimum? And we actually have a good setup with our investor base. So if we have that occasion where somebody gets in and flips it in 30 or 60 days, that's not an issue at all.
I think I'll mention right now that the hard money loan business in general has had to undergo some changes because of the rule changes on who can invest in trust deeds. And so we've been very fortunate to build relationships with people that have pretty high net worth, because to do a $500,000 loan, somebody actually has to have a $5 million net worth to be able to fund it. So not everybody can do that, and we're able to do that with you know, a fair number of our investors. So that's a big advantage that we have in the marketplace.
Yes, and you know, in regards to that, I think we're probably one of the few people that do the volume we do, and it's still like a one-on-one investor situation and not a pool situation.
Right. That's and we know that people on the money side really prefer avoiding pools, and so it's also lent us to getting some relationships that other people can't. As far as buying in entities, we're perfectly comfortable with limited partnerships and LLCs and all of the things that investors use.
Yes. What we generally do, we'll look at the borrower in terms of the individual first, and then as long as it's a legal entity in good standing, we don't really have a problem with what entity they choose.
Okay. We used to be at 60% after repaired value. We've moved to 65. And what was the thinking behind that?
Well, one of the advantages, you know, just obviously with the market research that you do and that's out there, it kind of moves with the market. So the market's definitely increasing. So probably a loan today at 65% is even safer than a loan, you know, 3 years ago at 60%, or it most certainly is. So we're always adjusting that depending on the direction of the market.
And I might mention also that we have a 0.4% additional interest if the borrower is not opted for direct deposit. So if we can get paid on a direct basis, it's a lot less hassle for us. So that's the only time a 12.9% interest would be charged on the Rehab program.
Yes.
Okay.
Yes, and then staying on this real quick, the time frame for funding, generally 10 working days is about average. Usually you have longer on most of the deals, but 10 to 15 days is very easy. And if somebody comes to us and has everything in hand, if we need to work quicker than that, we can, but 10 working days is about the average funding time.
And just elaborate, what is everything in hand?
Absolutely. Basically, if it's a first-time person, and when we start a deal, Rhonda at the office here will send out an email that lists everything, but it's basically going to be the individual's information, a credit report. If they're buying it in an entity, it's going to be all of those items. Also, we're going to need escrow instructions and prelim along with fire insurance. So plus the appraisal. So once we get all those items in, we're ready to go. Much easier with a repetitive borrower because it really narrows it down to just needing escrow, prelim, and appraisal along with fire insurance.
And I would say at this point, I mean, we are getting a lot of new interest in the program, but people become quickly repetitive borrowers, which is helpful for simplicity. You already know how you take title. And it's actually easier and easier to fund for the money side too, because they're familiar with a track record of being paid on time. So repetitive business makes it easier for, I think, everybody.
Exactly. And then one other point while we're talking here, probably the one thing that holds something up the most would be needing exact vesting. So if you want to close it quickly and you made the offer in your name and you submit the app in your corporation and you're not sure if they'll change it, we really need to make sure that not only the escrow has it, but the seller will sign off on any difference in the contract, because lots of times we get everything we need except for that one item, and we really can't type docs till we have the exact vesting.
Okay. All right, let's move to the Refi program. This was entirely made possible because of the good relationships that you, Craig, have built over the years and the trust that the Norris Group in general has with people, because private money normally he doesn't want to hear about an 8-year term, but we now have approaching, what, 20 or $25 million in this program?
Yeah, probably I would say 25, if not even getting up to 30 with the way the last few months have gone.
Okay. So that's been a big deal, and I still don't think we have a competitor that has the length of time that is, but that's also now been adjusted in points, so it's now down to 2.5 as well.
Yes, it is, with the same minimum. So loans under 100 would still be the 2,500 plus 1,095.
Okay.
And the majority of these loans are probably in the 50 to 250 range. Most people that are buying these, they definitely want to see the property's cash flow.
Correct. Yeah, this is where we might see something under 100 for a while still in the Lancaster or Victorville, that type of area.
Exactly.
Now there is a prepay on this for the first 2 years?
Yes, there is.
Okay. Now, on the refi program, what's typically been true is that somebody's bought it for cash, they've actually fixed it, and then refied it after it was rented. And that's kind of the way we started the program as a requirement, but now we've added a new program where we'll actually do a rental purchase.
Yes.
When did that kick in, and is that becoming more common than the other one?
That's probably our most popular program at this time. Just skipping back real quick on the refinance program, the term on funding on that is probably still about 30 days.
Okay.
So that one's just a little bit longer, and hence really that's why, just the transition, that's probably why we ended up trying to figure out a way to do, people just kept coming to us, well, how can we purchase these rentals and not have to pay all cash for them? So essentially what we did is we all kind of came up with the idea to do, really it's kind of like combining the first two programs. We do a kind of a short-term loan, if you will, with one investor. You buy the house, just as you would in the flipper program, you fix it up. Once the property's ready to go, then what we do is we'll look for a person that's willing to go into it long-term, and then we assign them into that property. Now, the couple differences between the rental purchase and the straight refinance, you'll see on the rate sheet there that you have a modification fee for $500. What that's for is that's actually in lieu of having to open up a new escrow and title. What we do is we just assign a new investor into the existing trust deed. We get an endorsement from the title company. So it's a very simple process. Actually, all the documents are signed by the buyer going into the first loan, and then they're just notified really when their payment changes, and we just do some work on the back end switching investors.
Okay.
A second point about this, which is starting to come up a little bit more, it wasn't originally, but every once in a while it's happened because the market has just gotten so strong. Somebody might buy something and maybe they just throw a listing out there, 20 grand over what they think it's worth. And sometimes in this market they're actually getting it. So if you'll notice there, the prepayment penalty for the first 2 years, that only kicks in once we assign it into the 9.9% program. So somebody actually could, geez, I just have to take this offer. As long as we haven't assigned it to somebody for 9.9, they would be able to do that without having a prepayment penalty.
Okay, just so I clarify, on the rental purchase, since it starts out with the 12.5% program, is that still fundable within 10 days?
Yeah, absolutely. That's the difference, the key difference between the two programs, and that's why we developed it, so we could, help people close deals quickly that they knew they were going to keep for rentals.
But we're also, on the rental purchase program, we're loaning to a vacant property that still needs work.
Exactly.
Where on the other one, you're usually dealing with something that's already rented and is already fixed.
Yeah, it's already fixed up and rented or rent ready.
Hey, Craig, this is Aaron really quick. I have a good question. We've got Gregory asking, do you still require 20% liquid on a rehab loan? Will you talk a little bit about the qualification process and what you'd like to see from them?
Yeah, it really varies a lot. The most basic requirement is probably, let's say somebody just back to the very initial pre-approval process, If somebody wants to be approved for, say, $200,000 with us, they probably need to have about 30% of that liquid, which would be about $60,000. So that would be above and beyond living expenses. So we definitely don't want to put anybody in a situation where, you know, they might be overextended. And it certainly still applies to the rental program, if not even more so, because with the rental program, you're going to have to be able to maintain the property, and you know, there could be some vacancies and things like that. So a typical amount into a deal currently is around 20% of the deal. And when we say in, just to answer that, it doesn't mean down. And what I mean by that is if you buy something for 100 and there's 20 grand in repairs, it doesn't mean that we're going to do a loan for 80. It probably means we're going to do a loan for close to 100,000, but we're going to hold the 20 grand for repairs. So you'd still have 20 grand into the deal. You'd do the rehab, you'd get the money back, and you know, you'd end up with maybe 20,000 or so in a typical deal like that.
Okay, I have one more question. Oh, sorry, Dad. Go ahead.
Absolutely.
No, go ahead, Aaron.
One more question by Ms. Clark. When you switch from a 12.5 to a 9.9 on the rental purchase program, do you lend 65% on the after repair value or purchase price?
Okay, everything we do is actually after repaired value, so we'd appraise it for what it's going to be worth on that program. So the actual flip loan is going to be at 65% of the after repair value. And then when we go into the long-term loan, it's just a matter of modifying the terms, but the amount will still be the 65% of the after repaired value.
Yeah, so in the conversion, there isn't a change of the loan amount at all.
No.
Correct. So the rental purchase program has been a big deal because a lot of the properties are being bought to buy and hold. So that's been a new program that's been very well received. What's coming, just starting now, we have I know, at least a half a dozen of construction loans, built to flip loans. That's just started, and we know that group of people intend to do dozens of them. So let's talk a little bit about the build to flip program. We're going to be charging the same 2.5 points, 65% loan to value again. How will that be determined as far as what the property is going to be worth since it doesn't exist?
Yeah, actually I think on that one we're at 60% of the appraised value.
Okay.
What we do basically is we go off of plans and permits. So I guess the starting process of that, I'm going to go ahead and use an example that we're working right now because it's fresh in my mind. So we have a client that has some lots in Corona. They've actually built the model already, or the identical property. So we were able to go out there. We did an appraisal on what the property will be. It's going to be worth about $420,000. So our loan amount is going to be $252,000, which is going to be 60% of the $420,000. What the client's going to bring to the table before we'll fund the deal, they're going to have the land owned free and clear, plans and permits in hand. So that's probably going to be about $120,000 that in this particular case that they're going to be into the deal. Once all that's in place, what we do is we fund the loan. We're required now with some of the other changes you mentioned, there has to be a third-party fund control. We have a company that we're using. It's probably going to be roughly around 1% of the construction cost. We'll take the balance of the $252 will go to the fund control company. You can meet with them, and depending on your needs, they usually set up a schedule where they'll go see the properties either once a month or once every 2 weeks. And at that point, they'll just look at the progress of the project. They'll recommend to us how much should be released, and then we'll authorize that release, and it'll just kind of grow from there. And it's going to be good because the third-party company will keep track of all the sign-offs and everything else. So it's pretty all-inclusive for them. Once we fund the deal, they'll have a lot of responsibility in making sure that everything gets done correctly.
Craig, I have a few questions on this, if we can hold on for a second.
Okay.
For investors adding square footage to properties, it's actually not the build-to-flip program. That would just be the standard flip program, correct?
Yeah, absolutely. If they're adding square footage, it would be the just the build to flip. And just following up on that, we
Okay,
kind of do that.
Just, I don't think you meant to say that it's the build to flip
Oh,
program.
yeah, yeah, absolutely. Thanks, Bruce.
Okay.
It's just the standard Rehab Program. And following up on that, just as with any other house, the ARV on that house, let's say it's a 1,000 square foot house and they're going to add 1,500 square feet, we would do the appraisal as if it is 1,500 square feet. So that would give them their after repaired value. We'd hold the necessary funds, and then we would actually fund control that ourselves. I would imagine if it got too excessive, over 100 grand, we wouldn't, but I don't think we've had that case. Most of those are 60 to 80 grand. So that would definitely work just like the Rehab Program.
One more question. Do you lend per lot? If we have 9 lots but 2 are funded by someone else, will you fund some of the other lots? So
yeah, in other words, each one is individual, if that answers the question. So
I think so.
We won't lend any money on the lots per se, but we will lend money on the other 7 to do construction. Now, it could be an issue if whoever lent on those 2 lots tied up the entire 9 lots. So the 7, let's say in this example that we would be lending, those lots would have to be free and clear.
Great, thanks.
I just also want to mention a lot of the flexibility that we have to do these programs comes from the consistent payments on time by the bulk of our borrowers. So I just want to stress that how important it is that when you get a loan and you make your payments current, it actually is a big help to us asking for us to be able to go, let's say, from 60% loan to value to 65, because they feel very comfortable that we're making the right decision and loaning to the right people. So I guess I want to say thanks for everybody making their payment. Our payment track record is better than Fannie Mae's probably at this point. So it's a real helpful thing in the hard money loan business to have everybody current. Okay, so build to flip, and there's also a build to hold program. So let's talk about that.
Okay, yeah, basically this is something nobody's taken advantage of yet, but certainly I think it could be coming. In a way, it's kind of just like the difference between the rental program and the purchase to rental program. It's the same concept here. Basically, somebody would they would build build the property out under the same terms that we just discussed, and then you can see in there's that $500 modification fee. So once the property was finalized and signed off, if they wanted to put a tenant in there, we could go ahead and get an investor in to go the long-term program, and we would go from there. And then I just want to make sure that I think you mentioned this, Bruce, but the interest rate on the both the build programs is 12.9, not 12.5.
Right. I did mention it, but I had thought about it just about the same time you did.
Okay.
So, yeah, so that's really the only cost difference. But there'll be plenty of areas where lots can be bought. I just bought several lots in Apple Valley for $15,000. I could actually build on that house and keep it as a rental, and it would cash flow. So there's areas where this probably will serve somebody well to build property and hold it as a rental.
Yeah, especially as it becomes more and more difficult to find those properties, because obviously that's where the greatest demand is right now.
Okay, and maybe one of the biggest changes that we have is the people that have used us for most of their business, where we now have what's called a frequent buyer program. So let's talk about the changes that we've done there.
Actually, can I ask one question, Craig, really quick, because this is one that comes up all the time. If we want a rehab loan on a property that we buy for $300,000 and its after repair value is $500,000, how much are we going to loan? In other words, can you get 100% financing?
Okay, on the
on any of the any program, let's just take the Rehabber program for instance.
Yeah, I mean, probably they're going to always have some money in. This is a question we always get. I mean, if somebody, in other words, that case there, they might have, 5% in plus cost. It just really, I guess, it's not a hard and fast rule, but there's still a large feeling on the money side that people, should have some money in the game. But I will say this, over the last year, that requirement has gotten a lot less, where, going back to that first question where he said, do we need 20% in some cases it certainly has been as low as 5%.
And I'll just add, how sometimes those decisions are made is considering who is borrowing the money and the track record they have with us. So if we know that somebody's very experienced and we have a payment history that's always been on time, and we know that the people have, enough money to solve things if they come up, that's all comfort level that Craig can, in fact, talk to the person putting up the money. So it is something that as we go through a market and the market improves, and as people borrow money over years and years, of course that's going to be, there's going to be some things that are available to people that have a lot of experience and have borrowed money over a long period of time. That's the nature of private money.
Exactly, and just one follow-up to that, the person that's most likely to get that is probably the person that doesn't need it to be that way. In other words, if somebody is pushing for that or trying to get that because they have limited cash, then that probably would be less likely a scenario for us to do it. So as Bruce mentioned, a lot of the clients, with experience, etc., I mean, if the deal just works out where they don't have much in, that's absolutely going to work. And I do see we're moving more and more toward a market where there's going to be less cash required. It's the type of thing, though, you kind of do everything gradually, like you go 60%, you kind of inch your way up, just like the 20% in, and we've kind of moved our way down. So certainly with the way the market's heading, that is the trend of where it's going.
Okay. On the frequent buyer program, that's brand new. So we're at 2.5 points, coming down from 3.5, but there's a way that it can be even 2 points. So let's talk about that.
Yeah, what we did is we talked a lot about this probably the last couple months, 2 or 3 months of last year, and I talked to a lot of clients that did a lot of business, and we always seem to get like thumbs up with service and everything, but it was kind of like there's numerous areas. There's interest rate, there's cost, there's loan to value, so there's various things, and it really seemed like the two areas of the greatest need for what clients were looking for were the cost. So with, say, as it mentions here, with 10 loans or the ability to do $1.5 million in loans per year, we would drop the points down to 2. What that would do on, say, smaller loans, that would make the minimum loan $2,000 plus the fees, and that might apply more on the long-term loans if that's what somebody's doing. And then we also will go close to 70% on deals for those people. So those were the two areas where they felt we could help them out the most, because a 5% difference, really even a 10% difference from, say, 6 months ago or a little bit longer, on a $400,000 deal, that makes a difference of, $20,000, $30,000, or $40,000 less out of pocket.
Yes. Now is that true for then all price ranges? So 500,000 and above. So everything now is 2 points except for something that would be under 100,000. Would that be accurate?
Yeah. In that category, anybody in that program is either going to pay a minimum of 2,000 or just 2 points on everything they do with us.
Okay. On this particular program, and I guess it's on the next slide, we have to waive the education credit rebate. When you guys usually borrow money, we give credits toward future education or even past education taken if it's a boot camp or I guess a series purchase. But because there's no margin here, we're going to not pay a education credit. Aaron, let's talk about the education credit program. We've gone to a 0.5% credit rebate because of the lowered points, and because we're doing 2 points for anything over 400,000, that amount won't be in the credit rebate program either. There's also going to be a 2-year window rule to use your credits. So we want to try and say, okay, you're an active buyer, you've got a lot of credits, we want you to use that so we don't have credits just lingering for 5 years plus. So there'll be enough events or enough boot camps that you can use your credits, and we'd like you to do that.
Okay,
Any other questions, Aaron?
I don't have any right now. Actually, Craig, this one does come up every once in a while. If you have more than one home that you want to put together, say you've got 3 rental properties that you're wanting to refi, are they all separate, or can you bundle them together to maybe get the value up?
Yeah, we usually don't do what would be cross-collateralization. We usually do each loan separately, so that's always been the that's always been the requirement. Just something popped in my head, Aaron, also in regards to that, because this is a question that might come up. Let's say somebody's out there and they have 5 properties, worth $100,000 free and clear, but they don't really have, say, $90,000 liquid to qualify for. In that case, just liquidity in the properties would qualify, because if we're doing loans on a couple of those properties, obviously as soon as we did those loans, they would have the liquidity. So
okay.
that would be a scenario where just common sense would say that they don't have liquidity, but with what they're going to do, they will gain the liquidity.
Okay. I was
going to add something too. The reduced program, a lot of people with trustee sales have partners. I'd have to believe that these new lower points would attract somebody to be able to leverage their own money instead of having a partner. So this is as reasonable hard money as I've ever seen. I wish I could have borrowed it myself.
Another
question. Aaron, did you say you were going to?
Yeah, another question. What is the trigger to drop the rate when we're dealing with the rental purchase program from the 12.5 to 9.9?
That's a great question. That's a great question. There isn't the trigger would be once it's fixed up and rehabbed. It doesn't have to be rented, but it has to be rent ready. And I want to throw out another point also as I'm thinking about this. One thing to kind of remember, somebody doing a rehab on a job to resell versus somebody doing a rehab job on a property to rent, the condition might be average versus good. And that's absolutely okay, meaning, that's okay, but we're probably going to appraise it in average condition, not good. So I just want to make sure I make that clarification, because a lot of times people will send over, a first-time deal, and absolutely the comps say 150, but all those properties are, rehab to flip deals, and maybe their property's only in, average condition, which probably 80% of our rentals probably fall into that category. So, they might have a $10,000 difference in the appraisal just because of the condition. With that being said, what we do is once the property's rehabbed, we have Rick or whoever does, did the original appraisal will go out and take pictures. They'll put it into the appraisal. They'll send it over to us. And at that point, we try to look for the long-term investor. So usually it's going quicker and quicker because we have a lot of people that want this program. They're just a different type. They're not, super quick reactive, the long-term investment portfolio. So that would trigger it. So we'd start to look for the investor. Maybe you have about 30 days to find an investor. And then what we do is all of our payments are either due on the 5th or the 20th. So we're also going to match up that payment date. So you might be maybe make 1 or 2 payments while it's under rehab and you're getting it fixed up, and then possibly one or two more until we get to that point where then the new investors in and then the new rate starts. So I hope that answered his question.
And by the way, we feel a lot more comfortable with this program because there's been such good response to people taking the 9% loans. In the hard money loan business, what happens normally, you're getting paid off every 5 months. So let's say if you have a pool of $10 million, you really could have a $20 million loan business. When you have a 9% program that's supposed to last 8 years, that money's off the shelf, and a normal hard money loan company would have turned that money maybe 16 to 20 times over the next 8 years. We're parking it somewhere. So
exactly.
The need for more investor support on the money side really had to kick in for this to be possible. Once again, because our clients, you guys, make payments on time, that allows faith to be developed in the program, and all of a sudden people start talking about it. We get referrals, and that's why it's worked.
Yeah, and if anybody's out there that is in that program borrowing, I can absolutely say thanks, because I'm able to say when somebody asks me about this program, I can say we have $25 to $30 million in there, and knock on wood, as to date, we have not had to file one notice of default. So that's really much appreciated.
And from an investor side on the trust deeds, I personally have the 9% trust deeds in my portfolio, and I don't even think about it. I just get a check, and I know I don't have to think about it for a long time. So it helps to be, when we talk about programs and people know that we actually own the trust deeds ourselves, they feel more comfortable with it.
Exactly, and as you know, I'm in that 100% myself. So
yes.
Another quick question is about how long does it typically take, Craig, to move from the 12.5 to the, so you've got the trigger moment where you're going to slide into the 9.9. Can we talk about on the long-term stuff, how long that takes to fund?
Yeah, I mean, I guess start to finish might be 4 months. If that's just if they want a number, in other words, a couple months, like, to get the work done, if you will, or get it going. Then maybe 30 days to find the investor, and another 20 days until it matches up with that payment. So it's real hard to say, because like some of the people get the properties done in just such a short time, and others it just seems it takes longer. So a lot of it depends on how quickly they get it fixed up and going. But from the time it's fixed up, usually there's an investor in place within 30 days, and then after that it's just a matter of depending on when that next payment date is coming up.
Perfect. Okay, that's exactly what they're hoping for.
I guess the short answer would be right. Inside of 60 days, once they're finished with what they had to do, they should have reflecting the lower interest rate of 9.9%.
There you go.
Another question: could you go over the new requirements to invest in trust deeds really quick?
Sure. Bruce, you want me to go ahead?
Yeah, go ahead. I'll add anything if I need to.
Absolutely. What they've done is they've really made it's a kind of basic requirement, or a black and white requirement. They're looking at your net worth, and they consider what they're looking for is your net worth minus any worth in your house or equity in your home. So what you have to have, like say if somebody wanted to invest in a $150,000 trust deed, they would have to have a minimum of $1.5 million in net worth. So they could not, we cannot put anybody in any one single trust deed that represents more than 10% of their net worth. And that's the basic requirement of that new regulation.
Yeah, just so everybody can see, I'm going to put in the new investor questionnaire in the chat box here in a second, so they can see what that looks like.
Oh, good.
The word that they used during some of the training that we got was suitability. So somebody that's going to want to invest in a trust deed, it's kind of incumbent on us as a company to take a look at their situation and see if this is suitable. In other words, do they even understand what a trust deed is? So you couldn't have somebody, let's say, that's 78 years old, that's retired, and their parent that was 100 died and they got $3 million, and they can't walk in here not having a clue about what real estate or a trust deed is and invest that money in trust deeds. That just couldn't happen, because it wouldn't be a suitable investment.
Exactly. And one question that I definitely ask when I'm talking to somebody for the first time, if somebody wants to invest $100,000, even if they meet the requirements, I mean, who knows, maybe they own a property that has a lot of net worth. If I think, or if they tell me there's any chance they might need that $100,000 before the term of the loan would be up, it's just not a good investment for them. In other words, liquidity should not be a potential issue for somebody investing in trust deeds.
Absolutely. Now, fortunately, 95% of our clientele investing in trust deeds was already there, and that's been nice. A lot of companies, well over half of their people have issues where they probably won't be investing in trust deeds anymore. So it's a big shift for our industry, not a big shift for us.